Hey everybody, how you doing? This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 27th, 2024. Appreciate you coming and watching this weekend's review of all the trades that I had last week, the Gossett Trading and Mentoring Weekend Review. I am broadcasting today and recording today, I guess, from Santa Marta, Colombia. I've liked it down here so much. I have extended every week. I'm supposed to go home and I just extend and extend. Who knows how long I'll be down here? Maybe I'll never go back. I'm not sure. But I hope you're doing well. Appreciate you tuning in. Hopefully this podcast will be helpful for you. Here is a picture of my dog Sky. This is the beach that I have been walking on each morning. Every morning, I'm in mountain time normally in Utah, and so I just wake up and start trading. But here it's a little different. I start trading at 9:30 instead of 7:30, so I get up, I go for a walk with Sky here, we go swimming, get home, I'm wide awake, have a nice breakfast. So I'll tell you, I'm not sure I ever want to leave. It's really a beautiful place. So anyway, hope you're doing well. And in the podcast today, this is going to be the format. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, both on the daily charts and on the weekly charts. We're going to talk about when I entered the trade, why I entered the trade, what was the strategy, what was my thinking, what were the confluences of signals that lined up of why I took the trade. And then after I took the trade, I position size correctly, I place my emergency stop, I place my end of day stop, I take partial profits on the way up once I get to a certain level to the upside, 1.5 ATRs from entry. I tighten up my stop even more, go into trailing stop mode. Then when I get up into the 65 RSI levels, the 70 RSI levels, then I have other rules as well. But that is what I'm going to show you, all the trades that I made last week and when I entered, why I entered, and most importantly, how I am going to manage the trade going forward. After that, we're going to talk a little bit about trader psychology, always the most important skill in trading. Everyone thinks it's some secret indicator. It's not. It's what goes on between your ears with following your process. You've got to get a process that you follow. If the market does this, then I'm going to do that. If it does that, then I'm going to do this. It's very important. I talk about it every week, but it's so important whether you learn it from me or whether you learn it from someone else. Fine, but get yourself a process, and more importantly, you have to follow that process. I really hope that you can do that because I want you all to be successful traders. But I've been trading for 28 years, and I'm just telling you from experience, you have to have a process. The process isn't always going to work, but it's important to get yourself a process where if you're wrong small, and if you're right, you have the potential for a big win. If you're wrong, it's totally fine. I'm wrong a lot, but when I'm wrong, I'm wrong. I'm usually wrong small, and I'm usually wrong quick, and I'm usually out. When I'm in a good trade, I stay in it. So you need to be very impatient with your losers, and you need to be very impatient with your winners, and you have to have a process that tells you what to do at all times. So after trading psychology, I have gone down through my watch list, both on the daily time frames and the weekly time frames, and I'm going to show you some potential levels that I'm looking for on these markets next week. Now, they may get there, they may not get there. If they get there, I'll consider taking the trade if I have a confluence of signals, if I have a good risk to reward ratio. If they don't get there, then that's fine. I'll just get on to another market that does get to my level. So I hope this is going to be helpful for you today. If you have any comments or questions, put them in the comment section. I'll do my very best to get to them as well. And if you find something in this podcast that you do like and you find a value, I would certainly appreciate it if you would subscribe to the channel and or hit the thumbs up button. It really does help the channel when YouTube knows that people think there's something valuable here by clicking on the like button. Okay, so let's get started. Let's get this legal disclaimer out of the way. It's about 42 seconds, and then we'll get started. I'll be right back. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, everybody. So like I mentioned, we're going to go through all of the current trades I have on the daily, both open and closed, and then also on the weekly. I'm going to do my best to explain my process to you and what I'm thinking and why I took the trade. If it seems confusing, I can assure you it's not the rules that I have are not difficult whatsoever, but you have to learn them. Later in the podcast, when we get to trades for next week, I'll go into it a little bit more. But if you are interested in working with me, if you're interested in learning from me, I do have a very good one-on-one course that I do in the evening time with my students via Skype. It's 5 sessions. Each session is 3 hours. It's a total of 15-hour course. I teach you all the different approaches that I use. I teach you all the rules that I use, and it's a great course. I have taught people from all around the world, from absolute beginners all the way up to the hedge fund level and everywhere in between. So if you are interested in learning the skill of trading, I'm very happy to work with you and teach it to you one-on-one. All right, so let's get started with Disney. So, in general, when I am approaching a trade, depending on the strategy that I use, but on this one, Disney, this is called a deep dip buy. And a deep dip buy is when you get a rejection of a 30 RSI level, a rejection of a 300-day moving average, a rejection of a 250-day moving average, a rejection of the 200-day moving average. And this one here in particular was a rejection of the 200-day moving average. And you can see the black line here is the 200-day moving average. It's that thick black line right here. This is a key level that a lot of large financial institutions and savvy traders will wait for the price to come down and test and reject this level. And if it does reject that level, then you need to position size correctly, and then that is your end of day stop. Well, you can see I bought this on the 11th of January. Why? Because during the day we went below the 200-day moving average but closed above. The closing price is a very important level, and most of my trades are based upon the closing price over a major moving average. So here's the black line. During the day we went under, but we were strong enough to close back over. It showed you there were not enough sellers below this 200-day moving average, and if you run out of sellers, well, then the price moves up. So first and foremost on Disney, I was, when I did the podcast, it was back over here, and I said, look, if it gets down to the 200, then I'll be interested in taking it because it will give me a good risk to reward ratio. I didn't know it was going to get there, but like I said at the beginning of the podcast, if it gets there, then I'll consider taking the trade. If it just keeps on moving up, then great for the stockholders of Disney, and I'll just get on to another market. So on the day that I took it, the reason that I took it was during the day we rejected the 200-day moving average, then we closed over the 200-day moving average. So first thing, okay, I see the trade, I see the signal. The next thing I have to do is I have to figure out, well, how many shares do I buy? And that depends on the volatility of the market and how much money you have in your trading account. So for the purposes of this podcast, let's just say we have a hypothetical $100,000 trading account, okay? I like to use 1%. So 1% of $100,000 is 1,000. If you have a $200,000 account, then 1% is 2,000. If it's a $50,000 trading account, then it's 500. So let's use a million, it's 10,000, right? So let's just use 100,000 times 1% is $1,000. I divide that by the value of the 2 ATR. The 2 ATR right now is $3.56. So 1,000 divided by whatever the value of the ATR, 2 ATR is at the time, divided by 3.56 tells me to buy 280.89 shares. So I just round it up to 281 shares. That is the correct amount of shares to buy the way that I trade for a $100,000 account and the volatility of Disney. That's all incorporated into the 2 ATR to figure out the volatility. So now I know how many shares to buy. Next step, I want to place my emergency stop exactly $3.56 below my entry, because if I have 281 shares and it moves $3.56, well, there's my $1,000 loss. That's 1%. Not fun to lose 1%, but you can recover from that. And the good news is that only 5% of the time are you going to get to your emergency stop. 95% of the time, if you have a loss, it's going to be because you have an end of day stop. Well, what is my end of day stop? Well, why did I take the trade in the first place? I took the trade because it went below the 200 and then closed above the 200. So the next day, had it closed below the 200, even a penny, I would simply be out for a very small loss. Remember, my max loss is down here, $1,000, 2 ATRs below, but that only happened 5% of the time. So we talked about why I took the trade, intraday rejection of the 200-day moving average, and a V1, by the way. And if you want to learn more about V1s, V2s, I have a free video in my YouTube channel about that. But I like confluence as a signal. So this was a confluence of the signal, an intraday rejection of the 200-day moving average and a V1, cherry on top, extra bonus points. It just helps increase your chance of having a positive trade. So I position size by taking 1% of my capital, dividing by the value of the 2 ATR. That's my position size. Next step, I place my emergency stop exactly 2 ATRs below. So I know what my end of day stop is, or my maximum allowed loss is going to be on my emergency stop. My end of day stop is a close below the 200-day moving average. If it did, it didn't. Okay, I have an orange line up here. This is my 1.5 ATR trailing stop level. This is exactly 1.5 ATRs. Right now it's 267. 1.5 ATRs above my entry. Compare that to 2 ATRs emergency stop below my entry. And if I get to this level, then I go into trailing stop mode, which means if I get a close below a previous bar's low, I am going to get out of half of my position. Okay, here come all the rules. Now, everything I've talked about so far, the looking for your entry, the position sizing, your end of day stop, your emergency stop, your trailing stop level 1.5 ATRs above, these are all defensive moves. We haven't even talked about profit, right? Because you need to think about losing money before you think about making money. So these are all defensive moves, but I do use offensive moves. And offensive moves are that I take partial profits if the market moves my way a certain distance each day from the previous day's close. This all factors around the value of the 0.45 ATR. Right now, the value of the 0.45 ATR, you can see here on my screen, is 80 cents. So I'm currently in this trade. Let's talk about it. Right now, the closing price is $95.36. I'm going to take the closing price, $95.36, add the value of the 0.45 ATR, which right now is 80 cents, plus 0.8. My first profit target for Monday, 96.16. Right now we're at 95.36, right? I took 95.36, added 80 cents to it. 96.16 is my first profit target for Monday. Now, I'm going to take my first profit target, 96.16, add 80 cents to it again. Now my second profit target for Monday is 96.96. I'm going to take that, 96.96, add 0.8 to it again. That is my third profit target. So I always have 3 profit targets for the next day. And how much do I sell there? 10% of any shares if I have remaining. If I have 800 shares left, well, then I'm going to place 3 limit orders for 80, 80, and 80 at these 3 levels that I just did the math on. And if it keeps going up each day, I set those 3 profit targets again. So that's what's great about the process that I use. First of all, we talk about defensive moves, looking for the signals, position sizing, emergency stop, end of day stop, getting to trailing stop levels, tightening up that stop. But the offensive part is selling into strength. Now, if we get up to the 65 RSI level, now the 5 EMA comes into play. And if we get a close below that 5 EMA, I'm completely out. If we move up to the 70 RSI level and reject the 70 RSI level, then I sell half of whatever I have remaining after all the profit targets that I took off. Then, if I have a close below a previous bar's low after rejecting the 70 RSI, then I'm completely out of the trade. And I know if you're new, this sounds complicated, but I promise you it's really not. If you work with me in my one-on-one lessons, I promise you'll be able to do this in your sleep. But I know at first glance this may sound complicated, and it's kind of hard to do it all in the time that we have for this podcast, but we're going to do our best. So with that being said, intraday rejection of the 200-day moving average, V1 entry trigger, position size, end of day stop, emergency stop, end of day stop, closed below the 200, trailing stop level. So as you can see, the next day moved up, took a little profits. Next day moved up again, hit 2 profit targets. So I'm reducing my position size, reducing my overall risk, selling it to strength. We also got to trailing stop level, and trailing stop level just means that now in the future, if I get a close below a previous bar's low, I get out of half. But you see, we have not had a close below a previous bar's low. So I have not had any stops to get me even out of any of the positions. So this position currently doing very, very well, Disney. Remaining shares from entry to exit right about 6.11%. So really good trade. So I spent a little more extra time on Disney because I'm just trying to lay the groundwork here. And so going forward, I won't spend as much time on explaining all of this. Okay. So Disney remaining shares up 6.11%. But again, look at my risk, everyone. This is the key in trading. Look at this risk. If the next day it's just closed 1 penny below, I'm simply out for a very small loss. I know what my maximum allowed loss is, but that's unlikely to happen. But even if it does happen, it's only 1%. But most of the time, 95% of the time, if you have your loss on these kind of trades are simply going to be a close below for a small loss. But luckily, went my way up 6.11%. So very happy with that trade. MasterCard. All right, these are open trades, by the way, still. MasterCard. Okay, this is what is called the return to value V1 or V2. This is another one of the approaches that I teach in my course. And if you'd like to learn more about V1s, V2s, again, I have a lesson on in my YouTube channel, V1s, V2s, totally free. Go and check it out. But this is called a return to value V1, V2. Value zone is between this green line and this green line. Anywhere in here is considered the value zone. So I don't buy above the value. A lot of people like to buy above value. I don't do it. I buy in value, sell above value. Buy below value, try to sell in value. So on this particular trade, this is called a return to value V2. We were above the value zone. We came into the value zone. I need some sideways motion. Got the sideways motion, and here is the V2 trigger. Bar 1, bar 2 goes below the low of bar 1's low. Bar 3 closes above bar 1's close. This is my entry. I position size. I place my emergency stop 2 ATRs below. Now, on this particular trade, there are no moving averages for my end-of-day stop, so I use halfway of the washout bar. You can see this red line here at 419. If I had a close below this line, that would be my end-of-day stop. Okay, I place my 1.5 ATRs above. If it moves up, I take partial profits. So I bought here at 420.04 on 108.24. The return to value V2. Next day went up a little, but not enough for a profit target. Next day went up nicely, did hit a profit target, also went into trailing stop mode. Next day gapped up, hit another profit target. Then we had some sideways motion, sideways motion, sideways motion. We moved up, took a profit target, moved up strongly, hit 2 profit targets, moved up again, took another profit target, and then we moved down here, and then on this particular day here, we closed below the 5 EMA because we got above 65 RSI level. I closed out the trade for a gain of 3.8. Is that 3.81 or 3.61? 3.81% with the close below the 5 EMA. So really good trade there. All right, USO trade. Sorry, I messed these up. This was closing trade. I only have one open trade there at Disney. So that was MasterCard. Exited that with a close below the 5 EMA. USO. All right. I took this based upon what is called a island reversal. And you can go to my YouTube channel, watch my video on island reversals or abandoned babies. I know, funny names. Back here on the 15th of December, I bought oil. Why? Because I had an island reversal. What is an island reversal? An island reversal is when you have a gap down. You see the previous day here, we gapped down. So there was a lot of bearish news, bearish sentiment about oil, USO. Next day we moved sideways, but then the very next day we gapped up. So you see how it leaves this gap to the left and gap to the right? We went from very negative sentiment to immediate reversal to bullish sentiment. In my experience, that is very bullish. So I did not buy here. The next day I bought on this dip. And on this particular trade, a little different structure on this particular trade, I am setting a 2 ATR stop below or a 4 ATR profit target above. I'm not on these types of trades. I don't scale out. I don't do what I do with my regular trades. It's just either I'm going to hit 2 ATR stop or I'm going to hit a 4 ATR profit. So it just moved around here, moved around here. I decided to get out of this trade. You can see I didn't quite hit my profit target, but I'm so close to that profit target. I have a lot of risk to the downside if I'm wrong. And really the straw that broke the camel's back to make me decide to get out of this was we got to the third ATR channel. This is the gray line here. 92% of prices fail here. So I thought, I'm just going to get out of the trade. I'm $1 away from my profit target, but I'm up so much on this trade that it seems kind of dumb, especially now that we're at the third ATR channel and I know that 92% of prices fail there. So this particular trade worked out very well. I did close it out for a total gain of 9.81%. So nice trade there. Apple. All right. Apple's another trade I closed out on Friday. I got long here on Apple the 17th of January. Why? Intraday rejection of the 200-day moving average, intraday rejection of the negative third ATR channel. I got long 182.43. I position size correctly. My emergency stop's 2 ATRs below. My end of day stop is just a close below the 200-day moving average. I place my 1.5 ATR trailing stop level above, and if it moves the value of 0.45 ATRs or higher the previous day, I start to scale out. The next day, took off like a rocket ship. I hit 2 profit targets. I'm also in trailing stop mode. Next day, moved up higher again, took more profit targets off. Next day again, moved up higher. It took more profit targets. Then we had a sideways motion day, another sideways motion day. On Thursday, we had a close below a previous bar's low. After reaching trailing stop level, I sold the remaining shares for a gain of 5.98%. And then on Friday, I closed out the rest of the trade with a close below the 5 EMA because we got to the 65 RSI level. So on Thursday, I closed out half for 5.98%. Friday, exited all of Apple on the second remaining half of 5.08%. So really good trade there. Tesla. All right, not everything is a winner, right? But the key is if you're wrong, to be wrong quickly and to be wrong small. I did get long on Tesla on the 19th of January. We had a under 30, over 30, and a V1. I positions buys, placed my emergency stop, placed my 1.5 ATR trailing stop level. Never got there. The very next day, this is a good example of getting in a trade, being wrong, and getting out quickly. I love to be in a trade and get out the very next day. One day, it didn't work, I'm out. If the trades are winners, hopefully I'm in them for many days. So I got out for a small loss of 1.52%. Then we just kind of meandered sideways, and then we had earnings. I never hold through earnings. Look what happened on earnings. We just came crashing down here. So anyway, good example of why I do not hold through earnings, but this was a losing trade of 1.52%. Walmart. Okay, another nice winning trade on Walmart, another deep dip buy. Bought all the way back here, everyone, on the 12th of December. Why? Okay, close under, close over the 250-day moving average. This is the key level, position size. Place emergency stop, 2 ATRs below. End of day stop, simply a close below the 250-day moving average. Placed my 1.5 ATR trailing stop level above. Next day, moved up nicely. Hit some profit targets. And we had a couple down days, but it didn't close below my end of day stop. Moved up again. Hit another profit target and got to trailing stop level. Here on the 20th was the first close below a previous bar's low. After reaching trailing stop level, I sold half for a gain of 1.53%. Then we just moved up, profit target, more profit targets, had a few days down, continued up, profit target, sideways motion, another move up, more profit targets. At this point, we're at the 65 RSI level, so the 5 EMA comes into play. I exited all of Walmart on the remaining shares of Walmart on the 24th with a close below the 5 EMA with a gain of 5.71%. Now, Thursday and Friday, it just took off higher. Totally fine. I'm very glad to lock in that massive profit. Just look at my risk to reward ratio back here on when I bought it. So low, and look what this turned into. So exited the remaining shares there for a gain of 5.71%. UUP. All right, dollar. Why did I buy the dollar? I bought the dollar back here on the 28th of December. Why? 200-day moving average should give you a clue. Close under, close over. Position size, emergency stop, end of day stops, close below the 200-day moving average. Orange line is what? 1.5 ATR trailing stop level. Next day, after I bought it, moved up a little. Nothing to write home about, no profit targets. Next day after that, went up very strongly, took some profits off, got to trailing stop level. Next day, moved up again, another profit target. Then we had a week worth of just kind of sideways motion, no profit targets. Then we had another big move up, more profit targets, sideways motion. Got to, this was our first close below a previous bar's low here. I erased that for some reason. Sold half for a gain of 2.38%. Sideways motion, another nice bar up, took more profits there. And then on Wednesday, closed below the 5 EMA after reaching trailing stop level, gain of 2.45% and out of the trade there. So those are all the trades. So real quick recap, Disney remaining shares up 6.11%. MasterCard closed out for a gain of 3.81%. Oil closed out for a gain of 9.81%. Apple closed out the remaining shares on Friday for a gain of 5.08%. Tesla only losing trade there for a loss of 1.52%. Walmart closed out remaining shares on Wednesday for 5.71%. And then again, UUP closed out on Wednesday for a gain of 2.38%. Okay, so those are the daily trades. Let's get to the weekly trades now. Oh, man. I have been talking about this trade for so long. Apologize, but I've had this trade for so long that I'm annoyed talking about it, and you're probably annoyed hearing about it, but let's do it because it is a legitimate trade, and it's a very, very good one, and it shows the value of waiting for your price to come down to major moving average and then having that process that I talked about. Okay, I bought this back in March of 24 with on the weekly bars with the rejection of the 250-day moving average. During the week, it went below, closed back above. I got long here, 30.71. I position sized. I placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level above. We moved up, took some profits. Next week, little sideways. Next week, moved up, took some profits, and I'm in trailing stop mode. Then we kind of moved sideways here for a while. Back in June of 23, we had our first close below a previous bar's low. So I got out of half with a gain of 6.4%. Then we had another month or even longer move up, took additional profit targets. Then we had this big move down here. And I thought, well, I'm going to get stopped out because it looks like it's going to close below the 250-week moving average. Did not. Held above, barely, kept me in the trade because of my process, right? And now we have just gone straight up. Profit targets, profit targets, profit targets, profit targets. This week, more profit targets. So we are above the 70 RSI now. If I get a close below the 70 RSI, I'll sell half the remaining shares. If I get a close below previous bar's low after doing that, I'll be out of the trade as well. 5 EMA. If we close below that, simply out of the trade. This particular trade has been a monster, everyone. This particular trade, the remaining shares up 20.57%. And last trade here on the weeklies is Johnson & Johnson. All right, where's my weeklies? Here we go. I got long Johnson & Johnson here on the 15th of December. Why? Confluence of signals, an intra-week rejection of the 200-day moving average and a V1 entry signal. Got long at 154.27. Position size, place my emergency stop 2 ATRs below. My end of week stop, simply a close below the 200-day moving average. 1.5 ATR trailing stop level is the trailing stop level. We went sideways for a couple of weeks, no profit targets. The next week it moved up strongly, took some profits. Next week moved up again, got to trailing stop level. And now I'm in trailing stop mode. Well, that triggered on Friday because the weekly bar closed below the previous bar's low. I got out of half for a gain of 3.27%, and I still have half. Now, full disclosure on this trade, you always hear me talk about not holding through earnings. Well, I made a mistake, everyone. I did not realize it was earnings. Rookie mistake. I still make them even though I've been trading for 28 years. And look, here on earnings, I should have gotten out of all of the trade on the weekly before earnings at close at 162.43. I did not, probably because I'm in Colombia and I have a different schedule. But yeah, I accidentally held through. I didn't want to hold through, but I did. I would not have if I realized and I held through earnings. So bad on me for doing that, and it did cost money. But now that earnings are over, I'm just sticking with the trade here. Good thing it didn't gap down here, and I would really been bummed. But still, nice trade. Half remaining, the remaining shares of 3.27%. So on the weeklies, XLF remaining shares up 20.57%. J&J remaining shares up 3.27%. So those are all the trades. And really the only, I closed out so many trades this week. I closed out MasterCard, oil, Apple, Tesla, Walmart, UUP. So the only remaining trades here I have open are Disney on the daily and XLF and J&J, excuse me, on the weekly time frame. Now, I've had some requests for some day trades, to show some day trades, and I wanted to show you the day trade that I made on CCJ. And I kind of want to show you how I dovetailed these trades together. So in the podcast, was it last week? Yeah, it was last week. I was talking about CCJ, Cameco Corporation. I was talking about this bearish island reversal. You see how we gapped up? Everyone was very excited. And we moved sideways for one day and then we gapped down. This is a bearish signal. And I talked about in the podcast that I would consider getting long CCJ if we came back up to the bottom. See the bottom, the blue line, the bottom of the island reversal. Well, we did that on Wednesday. But I did not express the trade in a daily swing trade. I expressed it in a day trade. So on Wednesday, we got right to see the blue line. This is where I thought it would fail, and that's exactly where it failed. So it was a day trade, but I looked at the daily time frame to show me that we were at a level that would probably fail. And then I went to the 15-minute charts that day to express this as a day trade. So on the daily, I know that level is suspicious and will likely fail. And so here is the beginning. These are 15-minute bars. Here is the beginning bar on Wednesday when it got to the level on the daily that I thought it was going to fail, 48.70. So once we got here, I shorted the trade. And this isn't one or the other. I placed my emergency stop 2 ATRs above and I placed my profit target 4 ATRs below. So you see that? 2 ATRs above, profit target 4 ATRs below. This is not just a random place to short, because if on the daily, you know that this blue line was the bottom of that island reversal. And so I put the short on. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs. And so I just put it on, and lo and behold, oh, sorry, everybody. And I have my stops in on here, but you can see it was correct. And I was in this trade for 2 days. So I guess it kind of was a swing trade, but got short here 48.70. And then here on this big down bar, it hit my profit target at 47.08 for a gain of 3.33. Is that what it says? 3.33%. So there's lots of different ways you can trade using different time frames. Like this. I mean, this essentially was a day trade, but it was influenced by what the daily was doing because I knew where that level was. So anyway, kind of an interesting, different kind of trade that I want to share with you. Hope that's helpful. But again, these are the kind of things that I do teach in my one-on-one course. So, all right, let's talk a little bit about trader psychology before we start looking for the trades for next week. All right, so let's do a little bit of trader psychology before we start looking at the potential trades for next week, both on the daily and the weekly. This is from Jack Schwager, very famous author. He wrote the Market Wizard series of books about trading. I would highly recommend you read those. He interviews some of the best traders in the world and their thoughts on trading and how they approach trading. It's a great series of books. I really highly recommend Market Wizards, many different versions of it, but start with the first one and read them all. You're going to learn a lot. Let's see what and follow Jack Schwager, by the way, at Jack Schwager over on Twitter or X. All right, let's see. Winning breeds complacency. When trading is going particularly well, many traders will tend to get lax in both their trade entry and money management. They will be more prone to take trades they normally wouldn't and be less rigorous in their risk control. Does this ring a bell with anyone? Does this resonate with anyone? It's true, because when things are going very well, especially like now with this particular market, you can start feeling bulletproof. And honestly, the more money you're making, the more rigorous you should be with your trades. You should be extra cautious. When you have a drawdown, when a lot of traders have a large drawdown in their account, if they're smart, kind of reflexively, they will become very, very picky with their trades. They will be very, very tenacious with monitoring their risks and their end of day stops. And boy, they're out quick because they don't want to lose anymore. But when you start to have a really good run, again, it's human nature. You start to kind of maybe take trades that you wouldn't, and you be a little lax with your risk control. So everything with trading is counterintuitive. The when you're doing the best, you need to be the most vigilant about your risk control and your trade selections. Don't let the fact that you are making money make you be lazy, right? Don't be lazy with your trades. And this is from beginning traders up to the best traders in the world. It's just human nature that you start feeling bulletproof and you just start becoming lax with your trades and your trade management and your risk control. But juxtapose that with when you're doing poorly and you don't want to lose one more penny, so you're very tight, very strict. You should be very tight, very strict, even more now if you're having a good run. Because I can tell you many times during my trading career where you start feeling bulletproof and you throw stuff on. I might as well just make some more money here. I might as well make some more money here. And then things turn against you and they can go against you quickly. And in this particular market, we had bad earnings and guidance from Intel on Thursday night. In my opinion, we're very close to a top, right? And I try to warn you each week, be careful, be careful, be careful. Don't get sucked into this FOMO. Don't get sucked into this. I mean, trade it, fine, but make sure you have a very quick stop and you have a plan. So one more time from Jack Schwager, winning breeds complacency. When trading is going particularly well, many traders will tend to get lax in both their trade entry and money management. They will be more prone to take trades they normally wouldn't and to be less rigorous in their risk control. 100% true, everyone. Please be even more vigilant, especially if you're doing well. Be vigilant all the time, not just when you're making money. Be vigilant all the time. So thank you very much, Jack. Appreciate that. Appreciate all your great books, and follow at Jack at Jack Schwager over on Twitter. All right, let us get to potential daily trades for next week. Now, these are not where they need to be yet. If they were, I probably would have already taken them. Okay, so keep that in mind. You have to be very patient. You have to wait for the price to get to your level that gives you a good risk to reward ratio. All right. All right, so let's start with ARK, ARKK. Well, ARK had this tremendous move up here, just kind of out of control. And then look, straight up, straight down. Where to buy? Where to get into this trade, possibly? Well, you can see I've highlighted in blue 3 key areas where there will likely, not for sure, but there will likely be some buyers that step in. The 200-day moving average, the 250-day moving average, and the 300-day moving average. You can see way back here in November, we had a close under 200, over 200. Legit trade. Did it work out? Yeah, I would say it worked out really well. Now, when I look at a major moving average that's coming down to a major moving average, I always look to the left and say, okay, was this moving average here respected in the past? It certainly was. It was certainly respected back here. Does it mean that this time it's going to respect it? Absolutely not. But it's a good sign that if it respected it in the past, that it may respect it now. So what I am looking for here on ARK, potentially, if it gets there, next week is some kind of rejection of the 200-day moving average, the 250-day moving average, the 300-day moving average, or the 30 RSI level. This is a deep dip buy. Ideally, in my best case scenario, we'd move down, go under the 200, over the 200, and also reject the 30 RSI level as well. Will it do that? I don't know. Maybe the 30 RSI, it will reject the 250 and the 30 RSI level. Maybe it will reject the 300 and the 30 RSI level. It depends on how long it's going to take to get down here. So I talk about this each week. Be patient. Look at the chart. Say, these levels make sense. If it doesn't get there, don't take the trade. Why are you taking the trade? If there's no level, if there's nothing that you can construct your trade around, all right? And again, these are the things that I teach in my one-on-one lessons. You know, if you're considering taking it, do it. I promise you, when you're done with this course with me, you will be a much, much better trader. You'll have a skill that you can use the rest of your life. It's 15 hours, 5 sessions. Each session's 3 hours. It costs $1,750, but I promise you it is worth every penny. My email is in the link of this, or my contact information is in the link of this YouTube video. Reach out to me. We can start a conversation, but I know you'll be happy that you took the course, and you will learn something that you can use for the rest of your life, okay? So ARK, 200, 250, 300 potential moving average, or a 30 RSI. And again, everyone, I have 15 symbols I'm going through here. Theoretically, these could all trigger on the same day. Would I take all 15? Absolutely not. I would narrow it down to the best one. What makes the best one? The one that has the most confluence of signals, the one that has the best risk to reward ratio, the one that looks best on multiple time frames, the one that has the best relative strength of the market, that particular market compared to the broader market, right? It's like a little treasure hunt. And I mean, again, all of these could trigger on the same day. even if they do, I will find one that is the best one, the most confluences, the best multi-time frame confluences, the best risk to reward ratio. Again, these are the things that I teach in my class, okay? So ARC, 200, 250, 300. Let's go to Boeing. Boeing's been interesting lately. Right now, we have a couple potential levels for next week on Boeing. Me personally, we're at a 3551 RSI level. I would like to see Boeing go down, reject the 30 RSI. It's already rejected the 30 RSI once over here, under 30, over 30. But if we could reject the 30 RSI again, under 30, over 30, and the RSI rejection was higher than the previous 30 RSI, higher low rejections of the 200, of the 30, of the 250, of the 300, they're all better than lower lows. Lower lows tend to do this, bounce, fail again. Okay? What I like are higher lows. So next week, if we go under 30, over 30, very likely it will happen at a level that was higher than this level. Now, I could also consider taking Boeing if we got above the 300. I talked about that last week, or back above the 200. It just depends on what the price action looks like. I can't forecast how it's going to look. I know it when I'll see it, right? I know when I see what I like, but there's too many permutations, too many potential patterns that could play out here. So it's hard for me to kind of forecast that. So under 30, over 30, I would consider. I wouldn't buy. We have earnings coming up on the 31st of January. So even if I do buy it, I would have to get out of that. Maybe after earnings, we have a clear signal. But for right now, an under 30, over 30 is probably what I would be looking for. Cameco, I talked about Cameco on the day trade that I had. Let's get rid of this. Right now, I shorted it up here 48.70 because of this island reversal. If we do get back up to this level, I will consider re-shorting it. And that's about all for right now to the short side. We are working on a return to value. Look at the value zone. Here's the top. Here's the bottom of the value zone. We're above the value zone. We are coming back into the value zone. If I can get some sideways motion for at least another bar and then I get a V1 or a V2, then I would consider that. If we just race back up here, back up to 48.70, I would consider shorting. But as long as we stay in the value zone, don't go any lower, move sideways, then if I get a V1 or a V2, I would consider taking a return to value V1 and V2. And again, you can go to my YouTube channel, the lessons playlist, and look for the video V1s, V2s. Carnival. Okay, Carnival Cruise Line. Well, everybody wanted it. Now nobody wants it. Where would you think I'm interested in this trade? That's right, because I marked it in blue. 200-day moving average would make a lot of sense to buy CCL. Look over here, under 200, over 200. Was it a good trade? Could you make money on that trade? Absolutely, 100%. 200-day moving average would make a lot of sense to buy Carnival. So would the 250, so would the 300, so would the 30 RSI level. Right in here, though, if we get into this level here, we should be at the 30 RSI level with the confluence of the 200-day moving average. So this is what I'm looking for, if and only if it gets down to this first level, the 200. Again, 250, yes. 300, yes. But first stop, if I get some kind of good price action, rejection, bounce, intraday, rejection, close under, close over this 200, and ideally with the rejection of the 30 RSI as well, this would make sense. But what is that, like 14.70? So it's still more than $1 below, but who knows, it could get there, right? And I think it would be a very good risk to reward ratio. A lot better buying here than way up here, I would say. Dow Jones. Okay, so Dow Jones, obviously one of the major indexes. I am looking for a short on Dow Jones. And why? Well, this jumped out at me last night when I was going through the charts. Why? Look at this high over here. See all the green MACD bars? This is called bullish MACD. This is a momentum indicator. It goes up and up and up and up, and it is confirmed by these tall green MACD bars. Well, what happened? We pulled back about a week and a half ago into red, and now we are even higher now. See, we're higher here than we are here. Where are the green bars? There are no green bars. This is what is called a double top with a bearish divergence. I learned this from studying one-on-one with Dr. Alexander Elder. He loves to trade divergences, MACD divergences, RSI divergences, ATRs divergences. This is extremely bearish. This means that we've made new highs, but the MACD has not confirmed. The RSI has not confirmed. The ATR channels have not confirmed. Look at the RSI over here. At this height, look how high the RSI is. Now we are higher than that. RSI is way down here. This is, in my humble opinion, ready to take a move down, and I would like to benefit from that. How to short that? Now, how am I going to get in this trade? Well, I need a signal. A signal could be a rejection of the 70 RSI level. It could be a bearish V1 or V2. Right now on Friday, we have formatted the potential for a V2 on Monday if we close below 380.48, then you would have a V2. Bar 1, bar 2 goes above bar 1. On Monday only, if we close below bar 1's close, which is 380.48, then that would be a legitimate V2, bearish V2 entry trigger to the downside, especially in light of the double top bearish divergence, bearish MACD divergence, double top bearish ATR divergences, double top RSI divergences. This is a very bearish chart, but it could continue to go higher. Just because this is all happening, it doesn't mean that it's going to go down. But once we get a legitimate trigger, a rejection of the 70 RSI level above, or some kind of V2 to the downside, I will certainly consider getting short DIA. FedEx. All right, FedEx had a nice close under, close over 200 at the beginning of the week. That's worked out well so far. If I were to consider getting into FedEx, it would be right here with a pullback to the 200-day moving average, which would give me a higher low rejection of the 200. You can see this came from a lower low, closed under, closed over. But if this pulls back to the 200-day moving average, rejects it, intraday rejection bounce, close under, close over, and this low that it makes here is higher than this low, those are always better. So that's what I'm looking for on FedEx, is some kind of rejection of the 200-day moving average, higher low rejection. Goldman Sachs. Well, Goldman Sachs had an abandoned baby. See how we gapped up here, immediately gapped down? That's why I highlighted the blue bar here. The bottom of that abandoned baby, 384.40 is the level that I'm looking at shorting. You can see Thursday, it got right there and failed. It may have another attempt. If it does have another attempt and I like the price action, I will consider getting short Goldman Sachs. I'll place a 2 ATR stop above, 4 ATR profit target below on that short, just like I did with oil, but oil was bullish, okay? So the bottom of that abandoned baby, look, it happened. The next day, basically touched it to the penny, rejected. The next day, went up a little higher into that, rejected it, and then again down on Friday. So I'm looking for potential short swing trade 384.40, and or if it gets to that level, I may express the trade in a day trade as well. Okay, Home Depot. I am considering shorting Home Depot inside of this blue area. This is the top of the, I'm sorry, that comes down just a little bit. This is, sorry, this is what is called an order block. This is the highest high here before a structure change. We had a structure change. This looks like a bearish structure change to me, although we may poke our head back up in to this order block before we turn back down. So I am looking at potentially shorting Home Depot someplace between 363.30 and 356.20, but it will come down to the price action, look, maybe a V1, V2 to the downside, something. So anywhere in here is bearish in my opinion. But I still need a trigger, some kind of trigger to get me in. It's like a V1 or a V2, something like that. INDA. Well, INDA, which is the Indian stock market, has had a lot of bearish signals. We had a bearish island reversal here. We had a bearish abandoned baby here. What I'm looking for in INDA is right here. Here is the bottom of the abandoned baby, 49.58. If we can rally back into that abandoned baby there at 49.58, I will consider taking a short position on India. Southwest Airlines. All right. Well, Southwest Airlines had really, really good earnings. Went very far above the 200-day moving average. I would consider buying Southwest Airlines for two reasons. One, next week, if we reject the 200-day moving average, that would give me a good risk to reward ratio. Or you see the highlighted blue here. This is a fair value gap between the low of 119.24 and the high. Oh, sorry. And the shoot. Oh no, that's right. That's right. And the high of 117.24. You can see there's a fair value gap here, which is the blue bar here. We did move up. We changed structure to the upside. So if we get somewhere between 29.22 and 28.90, I will consider just getting long based upon that. My end of day stop will be a close below this low and or a rejection of the 200-day moving average, but somewhere in this area potentially. Morgan Stanley. Well, we bounced off the 200-day moving average very nicely. If it comes back and retests this 200-day moving average, I will consider getting in Morgan Stanley. I don't know if we'll get there. Doesn't look likely, but if it does, I will definitely consider it. Nike. Okay, Nike is setting up for what is called a potential higher low V1 or V2. The rule is we have to close below the value zone, which is the bottom of the green bars here. We have to rally into the value zone, and then we have to have a bit of a pullback and look for a higher low V1 or V2. It's a little tough for me to anticipate what this is going to do for this podcast because I don't know, but I'm looking to get long Nike, but I don't want to chase it here. We closed below the value zone. We've come into the value zone, which is good. Just need a little bit of a pullback and then a higher low V1 or V2. PayPal. PayPal, I am looking for a short. Why? Well, we had this big move down here. If we come back up and test this 200 and reject this 200-day moving average, meaning it goes above it, but then closes below it, I would consider getting short PayPal with a rejection of the 200-day moving average. I would place position size, I'd place my emergency stop 2 ATRs above. My end-of-day stop would simply be a close above the 200. It's just the opposite of the longs. If we reject the 200 to the downside, then if it closes below the 200, I get out. For a short, if we reject the 200-day moving average to the downside, I'd get short and then get out of it if it closed above. But I do like this as potential short. Qs. Did want to mention something on Qs here. More kind of broad-based than actual trade, but there's two important trend lines going on with the Qs. There's this long-term trend line that, look at that, amazing. Almost to the penny. When it got to that long-term trend line, it reversed down. Isn't that something? But there's also a trend line, these trend line here that's coming out into space here. This trend line below us most likely will give us some support, and that's really like $1 below us. So we're kind of stuck in a range here on the Qs. Anywhere up in here, we're going to have resistance levels. Anywhere down into this longer term trend line, we're going to have supports. And then UNH. All right, UNH really came down hard, then really bounced up high. For UNH, if we get above the 200-day, I would consider getting long UNH. If we pulled back and retested this 300 or this 250, I would consider getting long there. My ideal would it be to pull back to the 250 or the 300 and then bounce from there, because it would give a higher low. Okay, but if it does close above the 200, that is potential. I just have to see what it looks like. But if it pulls back and rejects the 250 or the 300, that would be a higher low rejection. All right, so just real quick recap. ARC, I'm going to do this very quickly. ARC, I'm looking for a rejection of the 250, 200, 250, 300. Boeing, I am ideally looking for a rejection of the 30 RSI below. Cameco, I'm looking for a rally back up to potentially 48.70 for a short. Carnival, I'm looking for a pullback rejection to the 200, 250, 300. Dow, looking for a short, just looking for a rejection of the 70 RSI or a V to the downside. FedEx, I'm looking for a pullback to the 200. Goldman Sachs, I'm looking for a short if we go up and test the bottom of the abandoned baby at 384.40. Home Depot, I'm looking for some kind of short between 363.30, 356.20. I know that's a lot of range, but I'm looking for a move up into here. Like a lower high V1, V2 would get me short. INDA, if we rally back up to 49.58, the bottom of the abandoned baby, I'm looking for a short. Southwest, rejection below of the 200 or the fair value gap between 29.22, 28.90, looking for a long. Morgan Stanley looking for a pullback to the 200. Nike looking for a higher low V1 or V2 sometime next week. PayPal looking for a short on a rally and rejection of the 200 above. Qs, just kind of a broader term trend line analysis show you that if we get up to these trend lines up here, that's really probably a lot of resistance. If we come back down, the lower trend line could act as support. And then UNH, really ideally looking for a pullback, higher low rejection of the 200 or 300, or potentially even a close above the 200. Wow, a lot of them. You know what it was a couple weeks ago, remember I was having a difficult time even finding anything because things were so high, but things have come back down, so that's good. Gives us some potentials. All right, these are weekly trades. These bars close on Friday, so this is what I'm looking for. Boeing. Well, I'm looking for some kind of rejection of the 200-week moving average. Now, this may happen next week because earnings are next week. It certainly may happen next week or even the week after that. But some kind of rejection of the 200-week on Boeing would make a lot of sense. Doesn't mean it would be profitable, but that's a level. There should be some buyers that are coming in there. And, you know, Boeing's gone from what, 267 down to 205. So there probably will be some buyers at the 200. But, you know, a bounce, close under, close over, or an intra-week rejection of the 200. I potentially be interested in getting along Boeing, giving that a shot. FXY is the Japanese yen. Well, we have an order block here. Here's the red bar. We had liquidity, we ran liquidity, we changed market structure to the upside. We are coming back down now, but there should be some type of buying here between 6207 and 6117 by virtue of this order block here. We are also going to have a double bottom bullish MACD divergence if we get down here. So this level between 6207 and 6117 does make a lot of sense for a potential double bottom bullish divergence fair value gap buy. I'm just going to have to wait and see, a V1 or a V2 in this area would make sense this week or next week. The Russell 2000 pull back to the 200, pretty simple. If we get it, don't know if we will, but if we do, I would consider it. Pfizer, been talking about Pfizer. We have earnings coming up. Right now, I can just tell from experience that if I look at this low with the deep red MACD bar, if we come back down to test this low, which is possible, we will have a double bottom bullish divergence. So it may be next week, it may be the week after, but if we come back down, two potentials here. Well, no, really one potential. An under 30, over 30 would be a legit signal, especially in light of the double bottom with the bullish divergence. But it may not happen for several weeks. There's potential it could happen next week. I don't know. But if it does, I will consider it. But you have to factor in earnings as well. Tesla. All right. Well, Tesla, I did have a losing trade on that this particular week, but we are at a key level on Tesla on the weekly. I decided not to enter this. It's legit. This was legit. You see how we rejected the 250-week moving average here? So that is a legitimate entry signal. I decided to give it one more week to see maybe we go under and go back over again, show a double test of that 250-week. Of course, we have the 300 down here at 150. 152.17. I don't know if we're going to get all the way down there. We may, but two potentials on Tesla: rejection of an additional week's rejection of the 250-week moving average, rejection of the 30 RSI levels also come into play, or rejection of the 300. And then last but not least, I've been talking about VIX for quite a long time on the weekly. It just has not triggered, but I'll tell you, there's a lot of interesting things going on here with the VIX, and once it triggers, we may have a very large move up. We're at 2680 on the VIX right now. A close over the 30 RSI would be legitimate for sure. We have double bottoms, bullish divergences. When I look at VIX, it concerns me a lot about the market, because even though this looks horrible, it looks very ugly, but it looks very bullish to me just from experience. And if VIX goes up, the market will go down. That's why I've been a little cautious about the market, because I look at VIX every day and I follow VIX very closely. So right now we're at 2680. Close over the 30 RSI would be a legitimate entry signal. So anyway, I hope those were helpful there, everyone. If you have any comments or questions, please leave them in the comment section. I'll do my best to get to those, and hopefully those made sense. Again, I'm going to be very careful. A lot of these could signal all on the same day, but I want to narrow it down to the best one. So if you like today's podcast, really, I would appreciate if you could hit the thumbs up button. Really would help out the channel. If you're interested in doing the one-on-one lessons with me, please contact me. My email's in the link at the description. If you like online courses and you're not in the financial position to do the one-on-one course with me, I have a great course available at udemy.com. The link's in the description. I teach you step-by-step in that video course how to trade the deep dip buy stock trading strategy. I have sold many of those courses all over the world. Has, I think, like a 4.9 star rating on that course. It's very affordable. It's 9.5 hours of video, 26 videos total, 15 study guides, and the link's in the description. But check out that course. I know you'll be happy you did. And more importantly than everything, everyone outside of trading, please try to go out and try to do something nice for somebody today. If we just all did one nice thing for another human being, it would make the world a better place. It really would. If you could also go out and do something nice for an animal, and where's my animal? There's my sky right there. if we could do one nice thing for an animal each day, that would also make the world a better place. And animals really like acts of kindness and appreciate acts of kindness just like we do. So I appreciate you coming. I hope this was helpful, everyone. And greetings from Columbia. It's beautiful down here. I really, really like it. I'll be here for at least another week. So God willing, I will see you next weekend, and we'll see what these markets are doing. But please be careful, everyone. In my opinion, the market looks toppy vis-a-vis the VIX, vis-a-vis the technicals on the indexes. We've had a big run. Just logically it would make sense we have pullback. But if you've had a great run lately, I congratulate you, but please be careful. Please be careful. Tighten up your stops. Be even more vigilant. Okay? So just be careful out there. Don't get sucked into, we're going to the moon from here, because in my opinion, it's not going to happen. It could. I'm wrong a lot, but I just, kind of feel moved to tell you that, but I could be wrong. All right. But all right, everyone. Thank you so much. Enjoy the rest of your weekend. And on the way out here, I have to run the U.S. legal disclaimer. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.